In this lecture, we're going to walk through one of the more common examples when we're talking about current liabilities, and that's payroll liabilities. So there are lots of benefits and costs related to employees that extend well beyond salaries or hourly wages. And so some of these things include healthcare benefits, retirement benefits, paid vacations, employer-provided life insurance, and in addition to these benefits that are provided, companies do have to pay additional taxes to government entities that are additional expenses. And these include the employer portion of the Federal Insurance Contributions Act, which is sort of more commonly known as FICA. And there are two components to FICA. One is the Old Age Survivor and Disability Insurance, otherwise known as OASDI, and that tax rate is 6.2%. However, there is a cap for each employee where the 6.2% is applied only to the first $128,400 of income as of 2018, and every year that limit typically goes up. The other aspect of FICA is Medicare. With Medicare, the rate is 1.45%, and there is no limit on Medicare. In addition to that, the employer does have to worry about federal and state unemployment taxes, FUTA and SUTA. For FUTA, the combined rate is up to 6% on the first $7,000 of income. That's the federal limit. And what they mean by combined rate is that taken together, the federal government limits the total unemployment tax to 6%. So if the company is subject to a state unemployment tax, the federal government gives them a credit for that state rate. Actually, up to 5.4%. I should have said that. There is a cap on the credit they'll offer. And then there are state-specific rules for state unemployment taxes. So some of these transactions can lead to employee-related liabilities. There are federal and state tax payables. There's the employee portion of FICA, which are the same amounts as the employer portion. Sometimes employees make contributions to retirement, health insurance, and all these different items. And then finally, there are typically delayed payments to government entities, and those delayed payments usually is the employer portion of FICA, and FUTA and SUTA taxes payable. So let's walk through an example. A lot of information here, but basically you have a company with an employee. The employee earns $20,000 every month, and we're going to record the journal entry for the payroll on January and July of 2019, knowing that, of course, they would also have February, March, April, May, and June in the interim. And so there is a state unemployment tax and the credits and all this stuff that we'll kind of work through on each piece. So let's talk first about our January journal entry. We have to calculate FICA for the employee and the employer. Since we're nowhere near the federal limit, all of the $20,000 of income for the month of January is subject to both OASDI and Medicare. And so the amount of that tax would be $1,530 for this employee. We also have the federal and state unemployment taxes. FUTA, of course, they do receive a credit for the state rate of 5%, which would be a net 1%. And the federal rate is applied only to the first $7,000 of income, which means the federal unemployment tax would be $70 for this employee. And then the state rate, the gross rate was 5%, but because of their stable employment, the state gives them a reduction to that rate so that the effective rate is 2.2%. And in this case, we're going to assume that they had not reached the state max, and so it is applied to the entire $20,000 for a total of $440. And then we also are told that there's a contribution to the employee retirement, so the employee contributes to their own retirement of the amount of 3%, which is $600. So then we take all that information and we put it into a journal entry. And so we can see that their $20,000 salary and wage expense is kind of partitioned out into all these payables. The withholding taxes, which would be federal and state government, federal income taxes, and they have FICA, healthcare premiums, contributions, and then finally whatever's left over to actually write a check to the employee. In addition to the employee-related journal entry, there's an employer-related journal entry. So then we also have the employer portion, which is the payroll tax expense. And you can see the FICA for the employer is the same as the FICA for the employee. So there are two payments being made to the federal government. And of course, we also have the federal unemployment tax, which is FUTA, and the state unemployment tax, which is SUTA. And together, the company incurs an additional expense of $2,040 because of the employer-related payables. So now we move into July, and there's a couple of important things here. First of all, when we look at FICA, the limit, as you recall, was $128,400. And so if you kind of take them all the way through June, they would have had $120,000 of income, which means in July, there's only $8,400 that's still subject to OASDI. And so that $8,400 is subject to the 6.2% tax related to OASDI. At the same time, the entire $20,000 is subject to Medicare, or that 1.45% tax rate. So the total for the two is $811. The other thing going on is we have the federal unemployment tax and the state unemployment tax, and in this case, because we're well within any thresholds that any states might have, there's going to be no federal or state unemployment tax because they would have reached the limit for both the federal and state unemployment taxes. And of course, we still have the employee retirement of 3% of the gross, which is $600. So now you can see a slight difference in the take-home pay, the cash payment. And the reason for that slight difference is the FICA taxes payable has been reduced to $811 because of the OASDI having reached its limit. And then as far as the employer portion, of course, the only thing that's left there is FICA, and so the payroll tax expense is much smaller because of that difference.